more on the economy and navigating volatility in the capital markets. Let's bring in Amol Dhargalkar.
You got it right.
Managing partner and chairman at Chatham Financial. We want to take a 40,000-foot view of macro right now. I guess 462 is the word everyone's talking about today on the 10-year, maybe the 20-year, over 5%.
Well, it's early yet. Let's see where it goes.
Yeah.
First, thanks for having me on.
Thank you for coming.
I'm happy to share a little bit of perspective. We work with some of the largest alternative real asset managers in the world: real estate, private credit, private equity, infrastructure, public companies, financial institutions on capital market strategies. And it has been a really interesting week, I will say. In the last, since the Moody's downgrade, I think most market participants viewed that as, welcome to the party, Moody's. Third of the rating agencies to join in the downgrade of the U.S. And I think most people thought it was going to be a non-event. But to some degree, it's really the combination of that Moody's downgrade with this tax bill making its way through Congress that's leading to much more concern over deficit spending from companies who you would have never thought before. I was just in a room earlier this week with financial executives from about a dozen public companies, and the questions that I'm getting today versus the questions I was getting 6 months ago are very different.
If you could go in and rejigger some of the provisions in this bill that you just saw passed, would you get rid of some of the additional tax cuts? Would you try to cut more spending from certain parts of the budget? What would make the markets happy?
Well, I think, this was telling. I had a CFO ask me, do you think that they're going to actually raise corporate taxes now because of this? Now, this is not a theme that's come up anywhere else, but in the last week, these are the types of questions that people are asking because the reality of the U.S. budget deficit and, frankly, the interest on our debt. I mean, we're spending over $1 trillion a year on interest on our debt.
You buy into the growth provisions that's going to work and make these things less?
I think our clients are concerned. I would say, they want to see some of these provisions really executed in the tax cuts, but the real challenge is, and when you look at markets, it's really the 30-year. I mean, yes, the 10-year has moved. We're up a few basis points, year to date, which could be noise, but really the voting that the market is doing is over the long term.
That's what I think the real secret is. A lot of people I talk to say the same thing, not just corporate taxes, which nobody's talked about, but anywhere there's money. Yeah. They're going to have to go to the wealthiest Americans. They're going to have to go wherever they can find money to make up the potential shortfalls that are coming. And that's going to hurt growth from the top end. You're going to get squished from the bottom end as yields go higher. I mean, I think not a great scenario.
Yeah, that's really the challenge. And it's not just on taxes. It's, the entitlement spending is really that is the elephant in the room.
But if nobody's going to cut the entitlement spending, then all of these squeezes are still coming.
They're trying in this bill. There's an attempt, but again, interest on our debt is materially higher than anything we spend on Medicaid, and so marginal impacts on Medicaid are helpful.
Can we return to the corporate tax story? What do you think the rate could move to?
And who would move it? The Senate?
But by the way, the game of going down to 15%, that seems to have been eliminated already. That's long gone.
Companies, but so did the move from like Orrin Cass and J.D. Vance acolytes that supposedly were going to get us back to 25. That's gone. The president, he took that off the table. You think the Senate's going to say something?
I think the real question is long term. That's what our clients are asking about. Okay. So it's not what will happen in this bill, but if we pass this bill and we're living with it for a little bit, it seems likely to add to the deficit. Somebody will eventually have to come in and make some very difficult
talking about
decisions.
2028 and another administration.
It could be. It could be. And so, but again, what I'm trying to highlight is that really our client, that was not a question that anyone was asking, right? 6 months ago, people were talking about, can we actually reduce corporate tax rates even further? Today, there's this question of, okay, well, how stable is this policy that we're
What does the word permanent mean? Because we're making the 2017 tax cuts permanent. What, you're telling me it's not a permanent word?
What's it depends on your perspective of long term, right? And I think for our clients, the real challenge that they face now is in this higher interest rate environment, more deficit spending. there are asset classes that are more challenged than others. We work with a lot of commercial real estate investors. Even within CRE, highly levered investment vehicle, there are real challenges to the recovery of that industry.
Have you ever made comments on Bitcoin or crypto?
Have I ever made comments on them?
Would it ever be part of your world as a managing partner at Chatham?
I think we actually have clients that accept it as for payments. So it's been interesting to see that. But
because all the things you're highlighting, supposedly Bitcoin is the answer.
Well, it seems like it's the answer today as Bitcoin is hitting new highs. But again, let's see long term how it goes and how stable coins, central bank digital currencies. I think there's a lot of evolution that's going to happen that will impact firms.